Imagine waking up tomorrow and discovering that the entire foundation beneath the future of technology, what we've all been told will revolutionize everything, is built on sand. That might sound overdramatic, but what if the single biggest speculative boom of our era, driven by hopes, dreams, and hype, is far more fragile than the headlines let on? Welcome to the world of artificial intelligence, the buzzword of the decade, the miracle technology, the savior of productivity, the engine of everything, and yet, something feels uneasy. If you ask anybody what they think about the investment market surrounding AI, they're all going to say the same thing. We're in a bubble. And it's easy to see why they might think so. The entire market is being carried by a few firms speculating about the future of AI. They all play a game of saying a bigger number every quarter. The products they are releasing are a long way from covering the costs they're incurring. And every day, it just looks more like this whole game is being held together by tech CEOs passing around the same pile of money to make their numbers look good. This is to say nothing of the outside geopolitical risks that could smother this whole industry. The more you look into the current state of the market, the less flattering it looks behind the scenes. But the most dangerous thing in the world is not what you don't know. It's what you know for sure that simply ain't true. If everybody has agreed that this is a bubble, then why are informed investors still piling billions of dollars into it every month? Are they dumber than us? Or do they see something that regular people don't? Now, I want to say that, for the record, I think this whole thing is absolutely cooked. However, the best way to really understand something is not to seek out information that confirms your beliefs, but instead those that challenge them. So, to play devil's advocate, how is it possible that this whole thing is not just speculative mania? Today we'll dig into the anatomy of this AI boom bubble. In 3 parts, we'll break it down. Part 1 will ask, what's going on? What are the forces? Why does it look like a bubble? Part 2 will ask, if it's not simply a bubble, then what is this structure? Why bubble-shaped? What's driving it underneath the surface? Part 3 will draw conclusions. What are the risks? What are the possibilities? And what should you as an investor or observer do? Let's begin. From the very start, what we are witnessing isn't just another tech cycle. It is already being compared to past great bubbles. According to analysts at the Brookings Institution, while it's impossible to forecast bubble bursts with precision, there are 6 key indicators to monitor. These include total investment levels, data center construction timelines, actual adoption of AI, prices of AI products versus returns, the pace of competition, and public trust in the technology. Here's one headline: investment in AI is staggering. Trillions of dollars are being spoken of, yet the revenue streams are fuzzy. One recently published article in the Harvard Business Review noted that many AI firms don't have a profitable business model. Think of it as building a skyscraper by digging deeper and deeper into the ground, putting in more piles, but no one yet signs a long-term lease for the top floors. The building goes up, the foundations cost a fortune, but the tenants haven't arrived. In another comparison, the Federal Reserve Bank of Richmond looked back to the 1990s telecom boom and found a striking parallel. The surge in AI-related investments in equipment and software since late 2022 mirrors the jump we saw in communications equipment investment during the late 90s. So yes, it looks like the bubble script: massive capital flows, sky-high valuations, a few winners pulling ahead, many players riding on hopes of the future. But there's a twist, because perhaps this is not simply a bubble destined to burst. Maybe it's something more insidious, more complex. That's what we explore in the next part. Before we get there, let's pause and pick apart some of the major pieces of this picture. Piece 1. Concentration and scale. A handful of firms dominate the AI narrative. They control the chips, the data centers, the platform infrastructure, the models. Their valuations are enormous. One major company has at times been valued at more than entire national economies. When you see that kind of concentration, the risks magnify. If one link in the chain fails, it doesn't just affect a startup, it affects the entire ecosystem. Piece 2. Huge upfront cost, ambiguous returns, data center construction, specialized chips, massive infrastructure. This isn't like publishing an app. It's more like building a city from scratch. Brookings notes that some data centers cost upwards of $1 billion each. And yet, the revenues, many are projected, assumed to come, but actual results are thin. As in, does the cost justify the revenue? Not clearly, at least not yet. Piece 3. Narrative over reality. There's a story being told. AI will change everything. That story can drive valuations far ahead of actual deliverables. The hype becomes self-fulfilling to an extent. When everyone expects it, they behave as if it's real today, even if the real world isn't there yet. This is classic bubble behavior. Wired called it the ultimate bubble in tech bubble terms. Piece 4. External risks lurking. We cannot ignore geopolitical risk, infrastructure bottlenecks, power, chips, supply chains, regulatory unknowns, and broader macro risks. These are the shadows under any boom, and they tend to get ignored when narrative dominates. Pause for a moment and ask, if you were designing a bubble, what does it look like? You'd have massive investment, extreme valuations, concentration, huge promise, but weak near-term cash flows, lots of hype, and many players piling in simply because they don't want to be left behind. Well, we appear to be there. If you feel uneasy hearing this, good, because that means you're engaging critically rather than passively riding the wave. Now let's set up part 2, where we'll dig deeper into why this structure is bubble-shaped, and yet why it might not collapse in a traditional sense. There are forces in motion that complicate the simple boom and bust narrative. We'll look at how actual value might still be emerging, how the game is changing, and how the risks might be both more severe and more subtle than we realize. So far, we've set the scene. The world sees this as a bubble. The red flags are waving, yet money still floods in. Now, we dive deeper. Why this structure looks bubble-shaped, and why it might not collapse like a classic bubble. This is where things get interesting. One way to think of this is to imagine a skyscraper being built in the desert. Massive cranes, endless glass. Everyone expects tenants to rush in eventually, but as of now, only dust. The building stands tall, the prices of the property go up, and people buy space off-plan. That's our current AI market. Let's examine what's keeping the cranes moving. First, potential versus reality. When you break down the valuations of many AI-focused companies, you see future possibilities priced in today. According to research from Brookings Institution, one of the key indicators in assessing an AI bubble is the gap between the investment levels and the actual adoption/revenue outcomes. In short, a lot of the value is premised on what may happen, not what has already happened. Think of buying tickets for a concert that hasn't been announced yet, held in a stadium that hasn't been built. Second, infrastructure build-out with delayed payoff. Massive data centers, specialized chips, global networks, the backbone of AI. The Federal Reserve Bank of Richmond notes the investment trajectory in AI equipment and software since late 2022 closely tracks the telecom boom of the 90s, but at a far higher scale. That's significant. Why? Because infrastructure invests today for returns maybe years away. That means big risk of overhang. You build faster than customers arrive. If demand stalls, you've got expensive, unused capacity. But if demand catches up, the payoff could be enormous. Third, narrative and concentration. The story around AI is compelling. This technology will change everything. That alone fuels valuations. The technology's promise encourages irrational exuberance. According to World Economic Forum commentary, the trillions being poured in have triggered comparisons to the dot-com era and even tulip mania, the danger. When the story runs ahead of the substance, correction risk rises. But here's the nuance. Whereas in some past bubbles, value was purely speculative, this time real players are using the tech, albeit early and costly. Also, note the concentration. A handful of firms dominate. When you have one or two big winners, or perceived winners carrying an entire market, the risk is asymmetric. If they falter, the system shakes, but if they deliver, the upside could be systemic. Fourth, why bubble-shaped, but not guaranteed to pop like a balloon? Let's ask, what happened in the classic bubbles? In the dot-com bubble around 2000, valuations soared and companies burned cash with little to show. Then, when reality hit the pause button, many collapsed. Here with AI, there are real revenues, real applications, and real infrastructure being deployed. The question is whether they're sufficient to justify the scale of investment and whether they'll grow fast enough. That means even if the frenzy cools, you might not get a full crash, but you could get a long period of stagnation or underperformance relative to expectations. In other words, not every bubble ends in a dramatic burst. Some become drawn-out decelerations or sideways value traps. Fifth, hidden fragility under genuine possibility. This is the subtle part. When you have both promise and risk intertwined, you get a structure that is vulnerable in ways that people don't usually see. For example, the assumption that AI will scale globally, instantly, and across every industry. But what about supply chain bottlenecks for chips? Power and cooling demands for data centers? Regulatory and ethical constraints on deployment? Workforce shortages? These are not speculative, they're operational. If one link fails, delays or cost overruns can erode the returns. What's more, some research suggests valuation misalignment is already happening. A paper titled Anchoring AI Capabilities in Market Valuations finds that many firms have valuation premiums anchored to future potential that has yet to be realized. Put simply, the market is paying for what could come, not just what is. That's fine, except when it doesn't come. Sixth, feedback loops and self-reinforcement. Because the story is so powerful, and because large sums are already committed, momentum builds investors' fear missing out, FOMO. Companies invest to stay ahead. Governments invest to remain competitive. That creates a loop. More money goes in, valuations rise further, more attention follows. At the same time, big winners get even bigger. Creating a winner-takes-all dynamic. This, in turn, might reduce broad diffusion and concentrate risk in fewer nodes. When you concentrate risk, you reduce diversification and increase systemic fragility. Seventh, shift in value creation model. In prior tech cycles, new companies simply knocked out incumbents or created new business models. With AI, the model is less about replacing everything overnight and more about amplifying existing processes, data exploitation, and scale. That means two things. There is value, but it may accrue slowly, and the required scale for a return might be higher than anticipated. This is important when thinking about bubble shape. You might get long periods of expectation and investment without a dramatic crash, but also without the steep upside some expect. Let's put this into a more relatable analogy. Imagine a high-rise condo project in a booming city. On one hand, you expect hundreds of buyers. On the other, only a handful sign up and many units remain empty. The developer still owes interest on loans, property taxes mount, and the building looks shiny. Investors still believe because the city will eventually fill up. But if overall demand stagnates, you have an oversized asset with oversized expectations. That's the current AI infrastructure world. Now multiply that by global corporations, government mandates, geopolitical competition, and visionary narratives, and you have a system that is bubble-shaped but with serious stakes. Eighth, why many bubble calls miss the nuance. When somebody says it's a bubble, they often mean it will collapse suddenly, like a balloon being popped. But what we are likely seeing here is more complex. An era of accelerated investment and adoption, layered with speculative excess. That means a burst isn't the only outcome. An extended plateau or a slow unwind is also plausible. The World Economic Forum piece notes this. No two bubbles are exactly alike. Some leave behind more real value than others. So calling something a bubble without qualification can mislead. The The real question is, what happens if the growth fails to match the investment pace? That mismatch, more than the hype itself, is the hazard. Ninth, what could trigger a correction and what could prevent it? Trigger points. Large companies report that AI investments are not turning into the expected revenue growth. Data center utilization lags expectations. Regulation or public trust backfires. Data privacy, safety, ethical concerns. Macroeconomic shock, higher interest rates, recession, squeezes cash flows and financing costs. These triggers could lead to a sharp drop in valuations. On the flip side, factors that might prevent a systemic collapse. If broad adoption kicks in across industries and geographies, boosting revenues, if the infrastructure built now becomes underused but valuable over time, i.e., the building finds tenants later. If government spending and defense strategic applications continue to support demand. If leading players manage to convert early investment into real cash flows. So the narrative may play out in phases: exuberance, cooling, consolidation, selective winners emerge. That's more likely than a dramatic pop followed by rubble everywhere. 10th, why you should care, what it means as an investor or observer. If you believe this is purely a bubble about to burst, you might stay entirely on the sidelines. But if you believe it's a bubble-shaped growth phenomenon with both huge upside and huge risks, then a different approach is needed. Here are a few implications. Valuation discipline matters. Don't buy simply because AI is in the name. Ask, has this company shown cash flows? Can it scale? Will the infrastructure pay off? Timing matters. If you're early, you may still win big if you hold through years of build-out. If you wait for the crash, you may miss the real winners. Risk of concentration. Because the market is top-heavy, few players dominating, risk of being wrong is higher if you mispick the player. Look for breadth. The companies that integrate AI effectively into existing profitable models may have better odds than pure speculative bet-the-farm plays. Expect patience, because the timeline is uncertain. Unlike an immediate revolution, this may be a long evolution. Be ready for a reset. Just because it may not pop like a balloon doesn't mean it won't reset. Manage accordingly. In a sense, the current AI market is both like the dot-com boom and unlike it. It has the speculative elements, the high valuations, the narrative dominance, but it also has real technology, real adoption, real infrastructure being built. That dual nature means it's more precarious in a subtle way. The risk isn't just collapse, it's under-delivering relative to lofty expectations, and in financial markets, under-delivery often becomes the catalyst for the correction. So by now we've asked, why bubble-shaped? We've seen how infrastructure, narrative, investment scale, timing mismatch, and concentration all contribute. We've seen that it may not be a simple bubble in the classic sense, but the risks are very real and perhaps greater than many believe. As we enter the final part, it's time to ask the big question: what does this all mean in practice? We've seen the hype-driven valuations, the concentrated players, the infrastructure build-out, and the subtle risks. Now, let's translate that into real-world implications. First, let's consider the most likely scenario. AI is neither a simple bubble that bursts overnight, nor is it an unstoppable juggernaut that delivers instant results everywhere. More realistically, it will unfold in waves. Periods of extreme enthusiasm followed by cooling phases, corrections, selective consolidation, and incremental adoption. Imagine a storm at sea. The waves are tall and chaotic. You can't predict exactly when the largest one will crash, but you can anticipate the rhythm, steer your ship carefully, and avoid capsizing. That's what the current AI market feels like. Turbulent, unpredictable, but navigable with strategy. Second, the winners and losers are becoming clear. Companies that simply ride hype without substance are exposed. Those with scalable infrastructure, strong integration into profitable operations, and real revenue streams are far better positioned. Some startups may collapse under the weight of expectations, while established firms that use AI to enhance efficiency may consolidate market share. Third, the timing of adoption matters enormously. The market is pricing in massive potential growth over a very short horizon. But reality is slower. Data centers take time to be fully utilized. AI models require refinement. Enterprise adoption is gradual, regulatory approvals are not instantaneous, and geopolitical factors may slow deployment. This creates a gap between perception and performance, a gap that can be exploited by savvy investors who understand the nuances. Fourth, there's a critical risk management lesson here. Investors must avoid the trap of following the herd blindly. If you bet solely on narrative, you risk riding a roller coaster with little control, diversifying exposure, focusing on companies with proven execution, and understanding operational realities can drastically reduce downside risk. Fifth, consider the macroeconomic lens. Interest rates, global liquidity, and regulatory frameworks all affect AI investment outcomes. Higher financing costs or tighter regulation can quickly expose over-leveraged players. Conversely, supportive policy, government contracts, and strategic adoption can sustain valuation levels longer than classic bubbles ever could. Sixth, real value is emerging amidst the hype. AI is not magic. It enhances productivity, automates complex tasks, and enables insights previously inaccessible. While valuations may overshoot fundamentals in the short term, the long-term integration of AI into key industries, healthcare, energy, finance, logistics, may create genuine, lasting value. This is why some investors are willing to look past the immediate speculation. Seventh, let's talk about the psychological dimension. FOMO, fear of missing out, drives irrational behavior, inflating valuations. But careful observation shows a shift. More sophisticated players are starting to price in risk, building hedges, and using staged investments. This selective discipline may prevent a catastrophic collapse, but it won't eliminate volatility. Eighth, what about the worst-case scenario? If AI adoption stalls, infrastructure costs remain high, or regulatory intervention slows deployment, valuations could drop sharply. Some players would fail entirely. The correction could be prolonged, damaging investor confidence and slowing capital flow for years. But unlike a purely speculative bubble, some real assets, data centers, trained models, intellectual property, retain value even in downturns. Ninth, how should you act? Evaluate fundamentals over hype. Look for companies generating cash, scaling sustainably, and integrating AI meaningfully. Consider timing. Don't chase the peak. Identify entry points based on risk-adjusted value. Diversify exposure. Spread bets across multiple players and strategies rather than concentrating on a single, hot AI stock. Anticipate volatility. Prepare for both corrections and rapid growth, understanding that swings are normal. Stay informed on geopolitics, regulatory changes, and infrastructure developments. They often drive hidden risks or opportunities. Finally, let's return to the key insight. This AI market is bubble-shaped, but its trajectory is more nuanced than a simple burst scenario. It is a complex, layered phenomenon, combining hype, infrastructure, real adoption, and strategic risk-taking. Some elements may falter spectacularly, while others lay the foundation for a long-term technological shift. In short, the AI market is a high-stakes arena. It's messy, it's exciting, it's dangerous, and it demands both caution and intelligence from anyone seeking to participate. Think of it as walking a tightrope over a deep chasm. A misstep can be costly, but careful balance can carry you across to opportunity. So what's the takeaway? Don't assume it's just a bubble. Don't assume it's a guaranteed revolution. Understand the structure, recognize the risks, evaluate the players, and stay alert. The narrative is powerful, but the underlying reality is complex. Navigate wisely, because this is one of the most consequential investment themes of our time. If this analysis gave you a fresh perspective, hit like, leave your thoughts in the comments, and make sure to subscribe. There's a lot more to unpack about AI, markets, and the forces shaping our economic future. Stay curious, stay vigilant, and above all, stay smart.